from Market Economics is Stephen Koukoulas. Stephen, great to see you. Donald Trump, let's just pick up where we left off with Bruce Wolpe in relation to the impact on Wall Street of the ongoing trade war. Just talk us through the numbers overnight.
Oh, look, at one stage, the Dow was down 900 points. It closed down about 750, which is about 3%. So the market saw this escalation of the trade wars, the Chinese retaliation by devaluing their currency, the yuan, as an escalation of this whole problem. Markets really disliked that, sold off stocks heavily, bond yields fell, the Aussie dollar got hit. So this market turmoil is very much a reaction to US and China. If they go head-to-head over economic issues, it isn't good news for global markets.
Is this a sign that China's really coming up against a wall, though, using its currency manipulation strategy because they're running out of things that they can put tariffs on?
That's a really good question because, of course, they're running a trade surplus with the US, which is why Mr Trump's so angry about this trade imbalance. So, in a sense, they can't really stop a lot of US imports into China because there aren't that many relative to exports to the US from China. The currency is one thing that they can change. They actually have a pegged exchange rate, we call it in financial markets. So every day, even before yesterday, they go into the market and set the exchange rate. The issue yesterday was that they actually made a major move on their peg for the yuan against the US dollar. It was above 7 for the first time in about a decade, and that was a real signal that the Chinese are saying, well, hang on, if you're tough on our imports, if you're raising the tariffs, we're going to depreciate our currency, and therefore your imports will find it even harder to get there.
That's so predictable. That is so predictable that this is going to happen. I mean, we've said it before it started, that these things spiral.
And that's what's
happening.
Yeah, that's what's been the market for some time. Markets have been fearful of this escalating. They were hoping that cooler heads would prevail out of Washington. They were hoping that Trump's getting some advice that's saying, hang on, if you escalate this, they are going to retaliate, and you get this, in fact, what we're seeing right now unfolding in the global markets.
I just wonder, this question as to whether Trump will see some room for a deal because he hates the markets. Well, I mean, falling. Like he spruiks when the markets are flying. He says that's because of my great economic management and so on. But when they're falling, what does he do?
Exactly. I think this, in a roundabout way, this actually could be a bit of a catalyst for a bit of a step back, a bit of a prevailing of cooler heads. Because with the market now down over 1,000 points over the last couple of trading sessions, Mr Trump would be hating it. As you said, he loves to crow whenever it reaches another multi-thousand sort of benchmark. He loves it, and it's a good sign. The economy is doing well in the US. It is growing. It's still got an unemployment rate below 4%. So he's got to be careful what he's trying to do in terms of the trade front, because it could spill over into the real economy and into markets, and that would, of course, undermine his perception of how well he's going.
Now, when it comes to the economy back home, the big decision today is the RBA decision on rates. And do you think we are likely to see another cut?
Look, they're on hold for today. There have been 2 in the previous 2 meetings. They've got rates to 1%. And there are some tentative signs domestically the economy is looking a little bit better. We've had retail sales edge up in the month of June. Housing still appears to be recovering after being hit very hard over the last 2 years. Auction clearance rates are still around about that 70% in Sydney and Melbourne. Prices have stopped falling. Business expectations for investment are a little bit better than they were, say, 3 months ago. So they're on hold for now, but they will say that if circumstances warrant it, and given that we have low inflation, they'll cut again if needed.
And in terms of you touched on the retail sales, a survey out suggesting that retailers themselves are more optimistic than they've been.
Yes, the Illion Business Expectations Survey does show that retailers, for the first time in about 3.5 years, are optimistic about the outlook, that the retail sector, which had been hit by us consumers not spending much, little wages growth, high levels of household debt, lower savings. Retailers are telling Illion that their expectations for sales, profitability and future employment is starting to lift. So if that comes into reality over the next few months, that would be a good sign for the domestic economy. It's not all bad news.
How much of that do you think is just the fact we've cleared a federal election, regardless of who won? We know people hate uncertainty and people do hold off making decisions until after a federal election.
I think that's a very important issue, and particularly the policies that were taken to the last election. Labor's policies on franking credits and negative gearing, whatever the economic merits of them, and they were actually quite sound policies, they were creating a little bit of uncertainty in the area of housing, negative gearing, and franking credits, people's income. So in a sense that issue has gone away, and coincidentally, we've had the 2 rate cuts and the tax cuts are through the parliament. They're hitting people's pockets now, is something that will probably buoy retailers. So, again, it's only a tentative sign. There's only been 1 month of actual retail sales numbers from the Bureau of Statistics that have been stronger. If it continues through to July and August, then perhaps, just perhaps, there'll be a little bit of better news in the economy in the second half of 2019.
And in terms of the budget outlook, how's that shaping up right now with the iron ore price being... It's still upwards of where the budgeted forecast. So
yes,
in terms of the projected surplus, it still looks...
It still looks okay, and the domestic economy is a bit weaker, but commodity prices are higher, and I reckon it's about a wash. So that 7-odd billion surplus for 1920 fiscal year, that's about right, I think. But the thing that we've got to be worried about now is that this global trade war is going to disrupt global trade. The iron ore price fell $8 a tonne last night. It's still at $99 a tonne, so well above what was assumed in the budget. But be careful, if the trade war escalates, the Vale mine in Brazil is starting to produce iron ore again after that horrid disaster a few months ago. In 6 months' time, we could see the iron ore price fall quite sharply as a combination of extra supply, global trade wars, impact on global trade.